explosion in Fremont that killed one father and two daughters just over a month ago tells me that Horizon Biofuels insurance company cannot pay out her small claims to the car that was damaged and the smoke inhalation she suffered after that explosion.
I'm like, look, my window got blown out. He's like, no, come look at your car. And that's when I noticed the back end was smashed in a bit.
She filed a claim with Horizon Biofuels Insurance at the recommendation of the plant's director.
Any insurance claims is so complicated that they don't know if or when I would ever see any reimbursement for this.
But despite all the stress, Leffler says she's not the one who's hurting most.
As hard as it is on me, it's got to be harder on them. 2 kids from our community are suddenly gone, and these people lost their whole future.
In Florida, the average homeowner now pays more than double the national rate for insurance, over $5,300 a year, just to keep a roof over their head. Hurricanes cost $100 billion in damages, insurers flee, and families drop coverage entirely. This is the Florida insurance crisis, a disaster reshaping the dream of homeownership. But how did protecting your house become unaffordable overnight? And what happens when the next storm hits? Hurricane Ian tore across Florida in September 2022, leaving behind a trail of destruction that would rewrite the state's financial record books. The final tally? More than $112 billion in total damages, making Ian the most expensive natural disaster in Florida's history. Roofs vanished, entire neighborhoods flooded, and the storm surge swallowed coastal communities from Fort Myers Beach to Sanibel Island. The numbers compiled by NOAA and FEMA reflect not just wind and water, but a cascade of ruined homes, shuttered businesses, and months of stalled recovery. Ian's impact alone eclipsed the combined cost of every major hurricane to hit Florida in the decade prior. In the years that followed, smaller storms and severe weather events added billions more to the ledger. Between 2020 and 2025, Florida averaged nearly $7 billion weather disasters each year. But nothing rivaled the scale of Ian. Insurers, reinsurers, and government agencies all cite Ian's $112 billion figure as the single turning point for the state's insurance market. Of that total, more than $65 billion was paid out in insured losses, checks written to homeowners, landlords, and businesses struggling to rebuild. The rest reflects uninsured losses, infrastructure repairs, and the long shadow of economic disruption. For comparison, Hurricane Michael in 2018 caused about $25 billion in damages. Irma, which swept through in 2017, was responsible for roughly $50 billion. Ian dwarfed them both, doubling the financial blow of Irma and wiping out decades of actuarial assumptions overnight. The state's catastrophic loss record, once measured in the tens of billions, now sits in the triple digits. NOAA's data shows that Florida's share of the nation's billion-dollar weather events has climbed steadily, with more than $400 billion in total damages from 2020 through 2025. Ian accounts for more than a quarter of that sum. The storm's aftermath exposed the limits of Florida's insurance system. Insurers scrambled to process tens of thousands of claims, but the sheer volume and complexity overwhelmed even the largest carriers. FEMA disaster declarations covered dozens of counties, and state emergency funds were quickly depleted. The numbers on the loss ledger are more than statistics. They represent the collapse of entire blocks, the loss of generational homes, and the sudden evaporation of equity for families across the state. As the dust settled, the question was no longer whether Florida could recover from one storm, but whether its insurance market could survive the next. Premiums for Florida homeowners began climbing long before Hurricane Ian, but the pace accelerated sharply between 2017 and 2022. During these 5 years, the average cost of a standard home insurance policy in Florida jumped by 45%. By 2025, the typical annual premium reached $5,376 for $300,000 in dwelling coverage, more than double the national average. In coastal areas like Miami and Fort Lauderdale, rates often surpass $8,000, while even inland cities such as Orlando now average $2,500 annually. Tallahassee remains an outlier, with premiums under $2,000. But that is little comfort for most Floridians. These increases are not just a response to past disasters. They reflect a new actuarial reality. The Florida Office of Insurance Regulations filings show a steady upward curve in rate requests, with insurers citing not only catastrophic storm losses, but also the rising cost of rebuilding. Construction inflation surged 35% since 2020, driven by supply shortages and higher labor costs. For insurers, every claim now carries a much bigger price tag, and replacement values, written into policies, are recalculated upward year after year. The pressure is compounded by the outlook for future storms. NOAA's climate projections warn that hurricanes affecting Florida are becoming more intense and, in many cases, more destructive. Catastrophe models used by insurers now predict that annualized losses for Florida properties could be 10 to 40% higher than they were a decade ago. These models feed directly into the rate filings that land on regulators' desks, and ultimately into the premiums homeowners pay. Loss ratios, the percentage of premiums that must be paid out in claims, spiked after each major storm, but especially after Ian. While Florida's Office of Insurance Regulation does not publish aggregated loss ratio data for every year, the pattern is clear in company filings. When losses consistently exceed premiums, insurers must raise rates, restrict coverage, or leave the market entirely. By 2022, several carriers reported loss ratios well above 100%, signaling that claims outstripped the money coming in. This cycle of actuarial stress set the stage for the wave of insurer withdrawals and non-renewals that would follow. For homeowners, the result is a market where premiums rise faster than wages, and the cost of simply keeping a roof insured can threaten financial stability. The pressure on Florida's insurance system is not just a story of past storms. It is a warning about the cost curve of the future, shaped by climate, construction, and the hard math of risk. More than 30 insurance companies filed exit paperwork with Florida's Office of Insurance Regulation in the months after Hurricane Ian. The filings, some just a few pages long, spelled out a blunt reality. The risk was too high. The math no longer worked. Names familiar to agents and homeowners, UPC, FedNat, TypeTap, began vanishing from rate sheets and coverage maps. Each departure left agents scrambling to find alternatives for thousands of policyholders, often with just weeks' notice before renewals lapsed. Emails and board resolutions reviewed by regulators show a pattern. Companies cited mounting losses, soaring reinsurance costs, and legal expenses as reasons for pulling out. Some carriers stopped writing new business altogether, while others withdrew from entire counties, especially along the coasts. Broker networks in Miami-Dade, Orlando, and Tallahassee found themselves flooded with desperate calls as agents tried to place coverage for clients whose policies were suddenly non-renewed. In the regulatory filings, the language is clinical, terms like market withdrawal and capacity reduction. But for homeowners, the impact was immediate. Options shrank overnight, and the pool of available insurers grew smaller with each new exit. The vacuum left behind didn't just affect those in hurricane zones. Even inland communities saw fewer choices and stricter underwriting. With every company that left, the supply of insurance shrank further, setting the stage for a surge in premiums and leaving agents with fewer levers to pull. The exodus created a market where risk was no longer spread thin, but concentrated in the hands of those willing or forced to stay. The sticker shock of Florida home insurance hits hardest when stacked against the rest of the country. The average Florida homeowner now pays $5,376 a year for $300,000 in dwelling coverage. That's more than double the national average, which stands at $2,181. Over the last 5 years, premiums in Florida have soared by 72%, according to Value Penguin data. For families in Miami and Fort Lauderdale, annual bills often reach $8,000 or more, sometimes 4 times what a homeowner in Tallahassee pays. In fact, Tallahassee's average premium is under $2,000, making it a rare pocket of relative affordability. Orlando, sitting inland, posts average rates around $2,500. But for most of the state, especially along the coasts, insurance costs have become a defining feature of household budgets. The gap between Florida and the rest of the nation is more than a statistic. It's a monthly reality for millions. In Miami-Dade, a typical homeowner might spend $650 every month just to keep their policy in force. Even in regions spared the worst storms, the cost of coverage eats into savings, retirement plans, and daily expenses. The pressure isn't limited to high-value homes or luxury neighborhoods. Modest properties in working-class communities face the same relentless climb. For many, the math no longer works. Rising premiums force tough choices: cut back elsewhere, raise deductibles, or drop coverage entirely. As insurance eats up a larger share of income, the line between financial stability and risk grows thinner each year. Florida's premium gap is more than a market anomaly. It's a stress test on the budgets of everyday people, from retirees in Broward County to young families in Orlando. The numbers set the stage for a growing wave of households opting out of insurance altogether, a trend that threatens both personal security and the broader housing market. A growing share of Floridians are now living without any home insurance at all. Surveys conducted in 2025 estimate that between 15 and 20% of homeowners have dropped their coverage, pushed out by relentless premium hikes and shrinking options. For these households, one hurricane or fire could mean financial ruin. Many are retirees on fixed incomes, families in modest homes, or recent buyers who stretched to afford their property only to find insurance costs doubling or tripling in a matter of years. The risk is not evenly spread. In some neighborhoods, especially along the coasts, entire blocks have gone bare, neighbors relying on luck and hope instead of a policy. Yet in a twist that defies the broader trend, a handful of barrier island communities saw their premiums fall in 2025. Places like parts of Sanibel and Marco Island recorded drops of 20 to 25%, an outcome driven by a rare combination of aggressive wind mitigation upgrades, new insurer entrants, and state-mandated credits. For most of Florida, though, these exceptions are out of reach. Inland and lower-income areas see little relief, and the vast majority of homeowners face a stark choice: pay the rising bill or risk going without. The uneven patchwork of coverage has left the state more exposed than ever. For every island resident who caught a break, thousands more are now one disaster away from losing everything. As the number of uninsured climbs, so does the potential for personal and economic catastrophe. Citizens Property Insurance, Florida's state-backed insurer of last resort, has become the backbone for homeowners who can't find coverage anywhere else. After a wave of private insurer exits, Citizens' policy count soared to 1.4 million in the fall of 2023, a record high that dwarfed its pre-crisis size. Each new storm, each non-renewal, pushed thousands more into Citizens' growing pool. But the safety net is stretched thin. Public filings and regulatory data reveal that Citizens now carries a level of exposure once unthinkable for a single insurer. Its liabilities run into the tens of billions, and in the event of another major hurricane, the question of whether it could pay all claims looms large over Florida's budget planners. The strain isn't just about numbers. Citizens' claims handling has come under scrutiny. with more than half of policyholders reporting claims closed without payment in some years. Official regulatory data puts citizens' outright denial rate between 13 and 17% for 2023 and 2024. Still higher than most national benchmarks, and a source of mounting frustration for homeowners. The reasons range from disputes over wind versus flood damage to documentation gaps that leave families in limbo. In coastal counties like Miami-Dade and Lee, the volume of denied or unpaid claims is especially acute, fueling a sense of insecurity even among those who manage to keep their coverage. Citizens' leadership points to efficiency gains, faster claim closures, and efforts to depopulate its roles by shifting policies back to private carriers. Yet the core risk remains. The state's own insurer is now the single largest concentration of hurricane exposure in Florida, and its ability to weather the next disaster is a question that hangs over every budget hearing and legislative session. Florida leads the nation in the share of homeowners' insurance claims denied outright. According to the National Association of Insurance Commissioners, denial rates for Florida carriers routinely run several points above the national average. While the U.S. as a whole sees about 8% of property claims denied, Florida's rate is closer to 13 to 17% for major carriers, with some years trending even higher. This pattern holds across both private insurers and the state's largest players, and it is not just a quirk of statistics. It's a daily reality for families waiting on repairs or facing uncovered losses after a storm. Denial letters often cite disputes over what caused the damage, wind versus water, sudden loss versus wear and tear, or whether a claim was filed soon enough. These technicalities, spelled out in dense policy language, can leave homeowners with little recourse. In coastal counties like Miami-Dade and Lee, the odds of receiving a denial are even steeper, reflecting both the frequency of claims and the complexity of storm damage. For many, the process feels stacked against them. Even when damage is obvious, the path to a successful claim is anything but straightforward. The frustration of a denied claim doesn't end with a letter in the mail. It pushes homeowners toward legal action, fuels public anger, and drives up the number of lawsuits, costs that ripple through the entire insurance system. Florida's top ranking in claim denials is more than a statistic. It's an everyday source of anxiety and a flashpoint for the battles that follow. Assignment of benefits, or AOB, became a household term in Florida as contractors and law firms used it to take over insurance claims from homeowners after a loss. With an AOB, a roofer or water mitigation company could step into the shoes of the policyholder, file a claim, and sue the insurer directly if the payout was too low or delayed. Court dockets filled with thousands of these lawsuits every month. Insurers say many claims were inflated or duplicated, but the legal costs alone often forced settlements. In 2021, Florida accounted for just 8% of the nation's homeowner claims, but nearly 80% of all property insurance lawsuits, costing insurers an estimated $3 billion in legal fees that year. Costs passed directly on to policyholders through higher premiums. Lawmakers responded in March 2023 by repealing the one-way attorney fee statute and restricting AOB use on new policies. The changes aim to break the cycle: fewer lawsuits, lower legal costs, and eventually relief for homeowners. Early results show a drop in new property insurance lawsuits, with citizens pending cases falling by a third between 2022 and 2024. But the legacy of the litigation boom lingers. Insurers still price in the risk of future lawsuits, and many cases filed before the reforms are still working through the courts. Premiums remain elevated, and even as new carriers enter the market, most avoid the riskiest properties. The legal cost loop that once fueled Florida's insurance inflation has slowed, but it hasn't disappeared. For many homeowners, the bill for years of litigation is still coming due. Florida's real estate market is showing the scars of the insurance crisis in every corner of the state. The statewide median home price fell to $415,000 in May 2025, down 2.7% from the previous year. But this modest average hides sharper drops in some of Florida's most desirable markets. Naples, once a magnet for luxury buyers, has seen prices tumble more than 8% year over year. On Sanibel Island, the median sales price plummeted from $1.3 million at the height of the pandemic boom to just $830,000 this spring. Sellers there are offering discounts of $100,000 or more, and homes linger on the market for months without serious offers. In Fort Myers and Cape Coral, the inventory surge is even more dramatic. Local MLS data shows over 12,000 properties for sale in early summer 2025, a staggering increase from just 30 listings 5 years ago. Buyers, spooked by soaring insurance costs and tighter lending standards, are holding back. The pace of single-family home sales has slowed since February, and median prices dropped another 4% in April. Condo sales are also slumping, with double-digit declines in Hillsborough, Miami-Dade, and the Southwest Coast. Some of the steepest corrections are unfolding in places that once led the state's growth. Osceola County, just south of Orlando, is now grappling with a fundamental mismatch between supply and demand. The glut of new construction and a wave of insurance-driven exits have triggered the state's most severe market correction. Gainesville, Palm Bay, Melbourne, Titusville, and Lakeland, Winter Haven are all flagged by analysts as very high risk for 15% or greater price drops in the coming year. Even Tampa, St. Petersburg, and Sarasota, long considered safe bets, could see prices fall by up to 10%. Across Florida, active listings reached 225,020 in June, well above pre-pandemic levels. The map of risk is no longer confined to the coast. The insurance crisis is reshaping the value of real estate from barrier islands to inland cities, leaving few markets untouched. Inventory across Florida's housing market has reached levels not seen since before the pandemic. In June 2025, the number of active listings statewide stood at 225,020, nearly triple the volume from just a few years prior. In Fort Myers and Cape Coral, MLS feeds show more than 12,000 properties for sale, a stark contrast to the 30 homes on the market 5 years ago. The surge isn't limited to coastal counties. Inland metros like Orlando and Lakeland are also seeing rows of unsold homes, with new construction outpacing demand and investors retreating from properties that once sold in days. This glut of listings is creating a standoff between buyers and sellers. Homeowners hoping to exit are forced to cut prices or offer incentives, while would-be buyers hesitate, wary of soaring insurance premiums and the threat of further declines. Real estate agents report that many deals now fall apart, not over price, but when buyers learn the true cost of insuring a home. In some cases, insurance quotes arrive days before closing, sending buyers back to the sidelines and adding to the growing pile of unsold inventory. The imbalance is most acute in Osceola County, just south of Orlando. A wave of speculative building during the last boom left the county with a fundamental mismatch between supply and demand. By early 2025, Osceola was experiencing the state's most severe correction. Developers who once raced to pour foundations are now shelving projects, and some neighborhoods sit half-finished, with for sale signs lining the streets. Analysts warn that Osceola's struggles could ripple outward, especially as other high-risk counties like Gainesville and Space Coast face similar pressures. The market's gridlock is more than a pause. It's a warning that the insurance crisis is now dictating the pace and direction of Florida's housing future. Condo owners across Florida are feeling the squeeze from two directions: a sharp drop in sales and a surge in monthly fees. In Miami-Dade, condo sales fell 21% in April. Hillsborough County saw a 20% decline, while Southwest Florida and Panama City reported drops of 15.5% and 27% respectively. The numbers are stark, but they only hint at the financial strain behind closed doors. After the Surfside collapse in 2021, which killed 98 people, lawmakers imposed strict new rules on condominium reserves. Associations are now required to collect and hold much larger sums for repairs. No exceptions, no deferrals. For many buildings, this has meant doubling or even tripling monthly association fees within just 2 years. Board minutes from Naples and Fort Myers show fees jumping from $350 to $600 a month, with special assessments reaching into the thousands. Some residents, especially retirees on fixed incomes, have been forced to sell or are now behind on payments. Condo board presidents describe the challenge in blunt terms. We're caught between rising insurance bills and state mandates we can't ignore, says one leader from a mid-rise building in Broward County. If we don't raise fees, we're breaking the law. If we do, our neighbors can't afford to stay. The insurance fallout isn't just about premiums. It's reshaping the economics of communal living. Many associations have had to cut back on maintenance, delay projects, or dip into emergency funds to keep up with insurance and reserve requirements. For buyers, the math is daunting. Lenders now scrutinize reserve budgets and insurance coverage before approving mortgages, making it even harder to close a sale. The result? More listings, fewer buyers, and a growing sense of anxiety in condo communities from the Gulf Coast to the Atlantic. The cascading effects of insurance and regulatory changes are forcing tough conversations in boardrooms and living rooms alike. As Floridians weigh the cost of safety against the risk of being priced out of their homes. In March 2023, Florida lawmakers passed a sweeping package of insurance reforms, targeting runaway litigation and aiming to stabilize a market on the brink. The new laws repealed the one-way attorney fee statute, restricted assignment of benefits on new policies, and set stricter timelines for filing and resolving claims. Regulators at the Florida Office of Insurance Regulation moved quickly, reviewing dozens of rate filings and licensing a wave of new carriers. By the end of 2025, 15 new insurance companies had entered the state, bringing fresh capital and cautious optimism to a battered system. Regulatory filings show that most of these new entrants are backed by private equity, insurance-linked securities, or traditional reinsurance capital. Their business plans often focus on inland counties and newer homes, steering clear of the riskiest coastal properties that drove so many predecessors out. Rate filings submitted in 2024 and 2025 reflect this selectivity, with premium levels still high by national standards but beginning to stabilize in some markets. In fact, data from the Office of Insurance Regulation shows that 27 companies requested rate decreases and 41 requested no change during this period, a first in years of relentless hikes. The presence of new carriers has allowed Citizens Property Insurance, the state-backed insurer, to start reducing its massive book of business. Citizens' policy count, which peaked at 1.4 million in late 2023, began to drop as policies were shifted back to the private market. Regulators and industry leaders describe this as a sign of renewed confidence, but caution remains. Many of the new insurers avoid high-risk zones, and the durability of the capital they bring is still untested. For now, the reforms have bought time and breathing room, but the question of whether this recovery can withstand another major storm lingers over every policyholder in Florida. Florida homeowners searching for relief from soaring insurance premiums are turning to a tool built into state law, the Wind Mitigation Credit. This program rewards upgrades that make homes tougher in the face of hurricane winds. Stronger roofs, impact-resistant windows, reinforced doors, and improved roof-to-wall connections. Each improvement is verified through a licensed inspection, and insurers are required to apply discounts based on the level of protection. For many, these credits are not just a line item, they're a lifeline. The savings can be dramatic. State data shows that homeowners who complete a full suite of wind-resistant upgrades can cut their insurance bills by as much as 40%. On a $5,000 policy, that's $2,000 back in a family's pocket each year. Even partial improvements, like adding hurricane shutters or upgrading roof fasteners, can yield hundreds in annual savings. The benefits are not limited to coastal areas. Inland cities such as Orlando have seen insurance rates flatten or even dip by up to 10%, in part because more homeowners are taking advantage of mitigation credits. The program is especially effective for homes built before the most recent building codes, which often lack the storm protections found in newer construction. Insurers provide a detailed checklist of eligible upgrades, and the state's My Safe Florida Home Initiative offers grants and low-interest loans to help cover costs for qualifying households. Yet the uptake remains lower than experts had hoped. Some homeowners are unaware of the credits, while others are daunted by the upfront expense of retrofitting an older home. Consumer advocates urge Floridians to schedule a wind mitigation inspection, gather documentation, and submit it to their insurer. The process is straightforward, and the potential for savings is real. In a market where every dollar counts, mitigation credits stand out as one of the few levers homeowners can pull to fight back against relentless premium hikes. By the fall of 2025, the mood among Florida's economists and policymakers is anything but calm. Internal projections from the Senate Budget Committee warn that the average annual premium for a standard home insurance policy could top $15,000 by the end of the year. For many families, that would mean insurance costs rivaling or even surpassing their mortgage payments. The warning isn't just about affordability, it's about systemic risk. Analysts point to the numbers. Insurance premiums in Florida have already climbed 72% in 5 years, with some coastal households paying more than $8,000 a year. The state's own data shows that nearly 1 in 5 homeowners have dropped coverage entirely, unable to keep up with relentless hikes. The crisis doesn't stop at Florida's borders. Experts at the Wall Street Journal and the Senate Budget Committee caution that the conditions fueling Florida's insurance meltdown, catastrophic storm losses, skyrocketing reinsurance costs, and a volatile legal environment are starting to appear in other disaster-prone states. California, Louisiana, and parts of the Gulf Coast face similar pressures as insurers reassess their exposure to climate-driven risk. The risk of contagion is real, and the stakes are national. With the average Florida policy on track to exceed $15,000, the state's insurance market has become a warning sign for the rest of the country. The Senate's memo frames the situation in stark terms. Without major intervention, Florida could face a housing crash worse than 2008, triggered not by bad loans, but by the simple inability to insure a home. The numbers tell a story of urgency, and the consequences could reach far beyond the Sunshine State. In 2025, Florida homeowners pay an average of $5,376 per year for home insurance, more than double the national average. Over 30 insurance companies have left the state since Hurricane Ian, which caused $112 billion in damage, the largest loss in Florida's history. Policies have risen 72% in 5 years, and 15 to 20% of Floridians have dropped coverage entirely. While recent reforms brought 15 new insurers and some rate relief in select areas, the Senate Budget Committee warns that high premiums, falling home prices, and mortgage rates could trigger a housing crash worse than 2008. Citizens Property Insurance, now Florida's largest insurer, denied more than half of its claims last year, and legal costs remain the highest in the country.